Okay, welcome to the deep dive. Today we are plunging into, well, a really critical topic in finance. It's something financial institutions use, kind of like a shield, to fight crime. Enhanced due diligence. You'll often hear it called EDD.
That's right. It's a cornerstone of modern financial crime prevention.
And we're working from some great material today, including excerpts from FinCrime intelligence, which gives us a, really solid base for getting our heads around this.
Good stuff to build on.
So our mission here, basically, to unpack EDD. What is it? Why do we even need it? When does it actually get used? How is it done? And crucially, why should you care? Why does it matter for the financial world and maybe even for you?
Okay, let's dive in. So enhanced due diligence, EDD. At its heart, it's about risk. It's a risk-based approach that goes quite a bit further than your standard customer due diligence or CDD.
That's the basic check when you say open a bank account.
Exactly. CDD is about knowing who your customer is, the basics. EDD, though, that's triggered when a customer or maybe a transaction seems to carry a higher risk, a higher chance of being linked to, well, financial crime.
Higher risk. Okay.
Yeah, so its purpose is really to investigate more thoroughly, to monitor things more closely. It means gathering, additional information.
More info than usual.
Much more often, things you wouldn't normally ask for. The goal is to get a really clear picture of that customer's financial life, their background, and importantly, their potential connection, their exposure to things like money laundering, funding terrorism, corruption,
Yeah.
all that nasty stuff.
Right. So it's about digging deeper because something has raised a flag.
Precisely. It's about understanding that specific elevated risk.
So this isn't for every single person walking into a bank then? It's targeted.
Absolutely not for everyone. It kicks in specifically when that risk assessment says, hold on, standard checks aren't quite enough here. It's scrutiny based on, well, specific red flags.
Okay, so when does that happen? What are these triggers that tell an institution, okay, time for EDD? Because the standard process isn't cutting it.
Well, the source material highlights several key situations. A really big one is dealing with politically exposed persons, or PPPs.
PPs, right? Heard that term.
Yeah, these are people in prominent public roles, government officials, heads of state, senior politicians, that kind of thing. Now, being a PP isn't illegal, of course not.
Yeah, sure.
But their position, their influence, it could potentially be misused by criminals, perhaps for laundering money or corruption. So they automatically fall into a higher risk category, needing that extra look.
Okay, makes sense. What else?
Also, clients who are based in, or maybe doing a lot of business with, high-risk jurisdictions. Places known globally for maybe weaker controls against financial crime or higher levels of corruption. Geography matters.
And high-risk industries, too, I think.
Yes, definitely. Certain sectors are just inherently riskier. We'll touch on those maybe in a sec. Another big trigger, though, is complex ownership structures.
Like shell companies?
Exactly. Things like trusts, shell companies, offshore entities. These can be, and sometimes are, set up specifically to hide who really owns the money or where it came from. That lack of transparency is a huge red flag.
Okay, that's a classic one. What about banks dealing with other banks internationally?
Good one. Yes. Cross-border correspondent banking. This is a really significant area. Imagine a bank in, say, London is processing transactions for a smaller bank in a country with maybe less stringent oversight.
Right.
The London bank doesn't see the smaller bank's customers. It just sees the transactions coming from that bank. It creates layers, potential blind spots.
Which criminals could exploit.
Precisely. Regulators everywhere are really focused on the risks in correspondent banking. Then, of course, you have just plain unusual or suspicious transaction patterns. Anything that doesn't fit what you'd expect from a customer based on their profile.
So big transactions out of the blue or weird international transfers.
Exactly. And lastly, as you mentioned, certain sectors flagged as high risk globally. Think virtual assets, crypto businesses, casinos, or dealers in precious metals. These often trigger EDD automatically because of the nature of the business.
Wow, okay, so it covers who you are, where you are, the structures you use, how you transact, and the industry you're in.
Yeah.
Quite comprehensive. And regulators expect banks to have this all written down, like clear rules for when to trigger EDD.
Oh, absolutely. It's not optional. Regulators demand clear, documented, risk-based procedures. They want to see that institutions know when to apply EDD and that they do it consistently. It's a core requirement.
Okay, so we've got the what and the when. Let's get into the how. What does this enhanced diligence actually involve? What extra steps are taken? It sounds like more than just checking a driver's license.
No, much more. And it's not a one-size-fits-all checklist either. It's tailored to the specific risks that were flagged. But the sources point to some common key components.
Like what?
Well, first, detailed identity verification. We're going way beyond just confirming a name matches an ID. It means gathering more documents, maybe different kinds of documents, and crucially, verifying the source of wealth and the source of funds.
Okay, source of wealth and source of funds. What's the difference there?
Good question. Source of wealth is about understanding where the customer's overall net worth came from. Like, did they build a successful business, inherit money, win the lottery? You need to understand the origin of their total assets.
Got it. Their backstory, financially speaking.
Kind of, yeah. And source of funds is about where the money for a specific transaction, especially a high-risk one, is coming from right now. Is it from their salary, from selling a property? You need evidence for that specific money.
Right. And verifying that must be tough sometimes.
It can be very challenging, requiring detailed proof. Then, for these high-risk relationships, you usually need senior management approval.
So it goes up the chain.
Exactly. A junior analyst doesn't usually sign off on onboarding a high-risk client alone. It needs review and approval from senior compliance folks, sometimes even higher.
Okay, what else?
Ongoing transaction monitoring is also ramped up significantly. It's much stricter for EDD clients. More frequent checks, maybe lower thresholds for alerts, comparing activity very closely against what you learned during the deep dive EDD process. Any deviation gets flagged fast.
So constantly watching.
Pretty much. Then there's adverse media screening. This means regularly searching news sites, databases, the internet, looking for any negative news or links to crime associated with the customer or their network.
Like finding out your client just got arrested or is being investigated.
Exactly. Or maybe linked to sanctioned individuals or involved in scandals. It's about reputational risk and potential criminal connections. Sometimes, especially for businesses, you might even do site visits or direct verification.
Actually going to see the business.
Yeah, or hiring someone local to do it, to check it's a real operation, doing what it claims to be doing, making sure it's not just a mailbox front. Wow.
And finally, enhanced sanctions and PEP screening. This involves using sophisticated tech to continuously check names against updated global sanctions lists and lists of PPs, not just once, but ongoing.
So it's a lot more intrusive, a lot more work. And you mentioned documentation is key.
Absolutely critical. You have to document every step, every decision, all the information gathered, why you approved or maybe rejected the relationship. It needs to be a clear, defensible audit trail for regulators.
Right, because the regulators will ask.
True.
Which brings us to the regulatory side. This isn't just banks being cautious, is it? It's mandated.
Oh, absolutely. EDD is a fundamental requirement under pretty much all major international and national anti-money laundering and counter-terrorist financing AML/CTF rules.
Like the big ones.
Yep. Think of the Financial Action Task Force, FATF, which sets global standards. Think of the EU's anti-money laundering directives, or national laws like the Bank Secrecy Act, BSA in the US, or the money laundering regulations in the UK. They all mandate EDD in high-risk situations.
And the sources mention specific FATF recommendations. Yes. For example, FATF Recommendation 10 specifically requires EDD for those situations we discussed. PEPs, correspondent banking, dealing with high-risk countries. It's non-negotiable if you want to be compliant internationally.
And what do regulators expect to see from institutions regarding EDD?
They expect clear EDD procedures written into the bank's formal AML policies. They expect staff to be properly trained, know how to spot risks, know what EDD steps to take. They expect meticulous record-keeping, that audit trail we mentioned. And they expect regular reviews of these high-risk files to make sure the risk assessment is still accurate.
And if institutions get it wrong, if they don't do EDD properly.
The consequences can be severe. Huge fines. We're talking millions, sometimes billions of dollars. Enforcement actions, restrictions on their business, and massive reputational damage, which can be just as costly in the long run. It's a very serious compliance obligation.
Okay, clearly critical.
Yeah.
But it sounds incredibly difficult to implement perfectly across, say, a huge global bank.
Yeah.
What are the big roadblocks, the challenges?
You hit the nail on the head. It's very challenging. One of the biggest hurdles is data quality and availability.
Getting that source of wealth info you mentioned.
Exactly. Customers might be reluctant to share deep financial details. Or, in some parts of the world, reliable documentation or public records just might not exist. How do you verify wealth originating from a country with poor record keeping? It can be almost impossible sometimes.
Yeah, I can see that.
Then there's the cost and resource strain. EDD is expensive. It takes time, skilled analysts, sophisticated technology, external data sources. It's hard to scale efficiently, especially if you have thousands of customers needing this level of review.
And I bet customers don't love the extra hassle.
That's the third big one. Balancing customer experience with compliance, asking all those probing questions, demanding documents, the delays it can cause, it can definitely create friction.
You risk annoying or even losing the customer.
Precisely. Customers might just go somewhere else that asks fewer questions, which isn't necessarily a good outcome either, right? It's a constant tightrope walk. Being thorough enough for regulators versus keeping the customer happy and the process smooth.
A tricky balance.
And finally, risk isn't static. Dynamic risk factors. A customer's situation changes, they might take on a political role, change their business activities, move money differently. The environment changes too, new sanctions, new high-risk areas identified. So EDD isn't a one-time thing. It needs ongoing monitoring and updates, which adds complexity.
So, constant vigilance, high costs, data issues, and trying not to alienate your customers. Sounds tough. Technology must be playing a huge part in trying to solve some of this.
Absolutely essential. Tech is key to making EDD more effective, more efficient, and frankly, more manageable at scale.
What kind of tech are we talking about?
The sources mentioned several things. AI-driven risk scoring is becoming huge, using algorithms to analyze tons of data points way faster than a human could to predict risk more accurately and help focus efforts where they're most needed.
So AI flags the riskiest stuff for human review.
Essentially, yes. It helps prioritize. Then there's graph analytics. This is really cool. It visualizes connections.
Like a relationship map.
Exactly. It maps out links between people, companies, addresses, transactions. It can uncover hidden ownership structures or networks involved in crime that you'd never spot just looking at lists of names.
Finds the hidden spiderwebs.
Pretty much. And automated screening is vital for adverse media and watch lists. Instead of analysts manually searching news sites or sanctions lists, automated tools scan continuously, 24/7, and generate alerts for relevant hits. Much faster, much more comprehensive.
And verifying documents.
Yeah, tech helps there too. Tools for document verification, sometimes using biometrics, can check the authenticity of IDs more reliably and quickly, catching fakes.
So the tech isn't replacing the analyst, but it's making them much more powerful, giving them better tools to focus their expertise.
That's exactly it. It spots red flags faster, handles the routine stuff, analyzes complex data, freeing up humans for the critical thinking and judgment calls. And integrating all this into case management systems makes that documentation and audit trail much easier to maintain.
Right. Which brings us maybe to the bigger picture. EDD sounds like a lot of regulatory hoops, but is there a strategic upside beyond just ticking boxes?
Definitely. Smart institutions view EDD not just as a compliance cost, but as a strategic asset. It's fundamental risk management.
How so?
Well, it directly helps manage several kinds of risk. Reputational risk, avoiding headlines about banking criminals. Operational risk, avoiding fines and process failures. And financial risk, preventing direct losses from fraud or facilitating crime.
So it protects the bank itself.
Yes, but more than that. By doing EDD properly on high-risk clients, you're actively preventing exposure to financial crime entering your systems in the first place. You significantly improve your chances of detecting suspicious activity early before major harm is done.
Catching it before it snowballs.
Right. Plus, having robust EDD builds credibility. With regulators, yes, but also with correspondent banking partners, with investors. It shows you're serious about clean business. And ultimately, it helps protect everyone, legitimate customers, shareholders, and the integrity of the whole financial system.
So in this climate of intense scrutiny and ever-evolving criminal tactics, strong EDD is really about building resilience and trust. It's that critical defense layer for the riskiest parts of the financial world.
Couldn't have said it better myself. It's essential plumbing for a safe financial system.
Okay, so let's recap. We've gone through what enhanced due diligence is, that extra layer of scrutiny for high-risk situations, why it's needed to fight financial crime, that triggers PPPs, jurisdictions, structures, transactions, sectors, how it's done deep dives into identity, wealth sources, ongoing monitoring, media checks. Its place in regulation absolutely mandatory. The challenge is data, cost, customer friction, dynamic risks, and how tech is helping, plus its strategic value. Quite a journey.
We covered a lot of ground.
Hopefully, for everyone listening, whether this was for your job, just general interest, or plain curiosity, you've now got a much clearer view of this complex but vital process and why it matters so much.
It's a space that's constantly changing, too. And that leads to a final thought, maybe something for you to ponder. We've talked about how financial crime adapts, how technology evolves both for the criminals and the institutions fighting them.
Right, it's an arms race
It
almost.
really is. So the question to think about is, given that rapid technological change on both sides, how will EDD itself need to transform in the coming years? What new components might emerge? How might the challenges shift? And how will its strategic importance evolve to keep pace? Something to mull over.